I want to get to one sector that might already be in recession. It's the auto industry. James Albertine joining us, MileOne Autogroup Strategy Vice President. He joins us on the phone. Jamie, great to have you with us. Walk us through your view on whether the sector you cover is already there.
Yeah, great. Thanks for having me, and good morning, everyone. I would tell you this. I mean, since I've sort of transitioned from my sort of analytical Wall Street role to being more on the front lines of our, automotive group, you might think we're in a recession when you look at auto stocks and valuations. I don't feel that way, from sitting on the front lines, if you will, at the dealership level. We're seeing a lot of very strong activity, not a lot of discussion. I mean, certainly from an analytical perspective, we're looking very closely at tariff discussions and trade and the potential, to have to pass through, those price implications in the form of higher transaction prices at the dealer level. But to this point, new products on the SUV and the truck side are selling extraordinarily well at record transaction prices. Credit is widely available. It just doesn't feel as though we're anywhere near a recession, again, from the front lines. Although, admittedly, the stocks do seem to be pricing that in.
Well, a couple of things we've got to hit there. One is the access to credit. We'll get to that in a moment. Walk me through what is happening with inventories and what you see in the auto inventory trades at the moment, Jamie.
Yeah, look, I think there are, the usual suspects that tend to carry higher inventories. The Chryslers of the world, the Nissans of the world are still doing that. I think broadly, we're seeing reasonably rational inventory levels. I would even go so far as to say that, we don't have enough inventory for the higher demand products on the SUV and the truck side. On the car side, there has been this slower, maybe it's sometimes a little faster, but it's sort of a steady decline and transition from cars to crossover utility vehicles. And so you could argue that, any amount of car inventory might be too much, considering that seems to be more of a pronounced negative trend. But broadly, if you were to take all that into account, it does feel, relatively rational at this stage.
So, Jamie, just a final question for you. As you know, on any given morning on Wall Street, there's always this one data point, this chart that gets flicked around on the email, and it's a catalyst for conversation. The latest is auto delinquencies, and it's not just subprime. Just a little bit of evidence is starting to bleed into prime as well. Jamie, what are you seeing just in terms of access to credit, which you say is still good, but the data I'm looking at says delinquencies are starting to pick up?
Yeah, well, if you take a step back, right, the two things that we have to balance, right, are sort of what I mentioned earlier, record high transaction prices. And we are in a rising rate environment, right? So we got away with having higher and higher transaction prices when rates were close to zero. Now they're going up. So you're naturally seeing, I think, some delinquencies there. But broadly, where people aren't able to sort of rationalize a monthly payment for a new vehicle or a new lease, we're seeing them transition to a late model used vehicle. So I don't think that's a suggestion that we're on the precipice of a major decline. I just think that sort of, we're somewhere in the plateauing stage of the new vehicle market, and people are making sort of rational decisions around monthly payments and transitioning between a 2 or 3 year old used vehicle versus a brand new record high price new vehicle.